Hi, this is Mike Larson from Money and Markets TV. Wall Street pundits and European technocrats keep assuring us that all is well, that the sovereign debt crisis is under control, and that stocks will enjoy their usual end-of-the-year bounce. And frankly, what would you expect them to say? They need your money to pay their salaries and bonuses. But I don't have those conflicts, so I'm going to give you the plain, unvarnished truth. Things aren't getting better. They're getting much, much worse. And it's only a matter of time before the unfolding crisis in the credit market spills over in a major way to the stock market. Sometimes a picture is worth 1,000 words, so I'm going to let the charts do the talking. First up is the 3-month euro-dollar cross-currency basis swap. Now don't let the fancy name fool you. It's simply a way to track how expensive it's getting for private European banks to fund their dollar-based loans and investments. As you can see, that cost is exploding to levels not seen since the last major phase of the credit crisis. In other words, nobody wants to lend to European banks because they're worried they won't get paid back. Next up is the yield on Belgium's 10-year note, which is surging to a multi-month high. This tells me that while most sovereign debt concerns are focusing on the pig nations of Portugal, Italy, Ireland, Greece, and Spain, it's the other credit markets like Belgium's where we can really see the fear of contagion taking root. And speaking of contagion, my last chart shows the spread or difference in yields between French 10-year notes and their German counterparts. As you can see, this spread just exploded to 190 basis points, or 1.9 percentage points. That's a fresh Euro-era record, and proof that investors are increasingly worried that France is going to lose its AAA credit rating. Now keep in mind, these aren't these small peripheral nations like Greece whose economies are tanking anymore. They're huge countries like Spain and Italy, and even core European nations like France. Even here in the US, short-term borrowing costs are rising steadily as banks have a tougher time finding other banks willing to lend to them. The 3-month LIBOR just hit 47 basis points, its highest level since last July. Plus, the 2-year swap spread is blowing out. It hit 50 basis points this week, the highest level in 17 months. That's an indicator that banks don't trust other banks, here in the US even, and they're demanding they pay much more if they want to enter into derivatives transactions. This is all a complicated way of saying that the credit markets are going berserk. Several indicators are at levels not seen since the depths of the last crisis or headed in that direction. Others are much worse now than they were then. These were clear leading indicators of a stock market collapse back in 2007 and 2008, and I believe they are clear leading indicators of a stock market collapse now. The only thing propping up stocks right now is the year-end effect, the need for those bullish portfolio managers to juice stocks in order to pad their own bonuses. But I don't think that one minor positive is enough to offset the complete collapse of the global credit markets. So please, folks, take advantage of the short-term lull in stocks to take profits and add hedges. And for your aggressive funds, consider specialized investment vehicles that rise in value when the stock market declines. I'm Mike Larson for Money and Markets TV. Thanks for watching.